Okay, so in this section, we're going to talk about how to actually value a self-storage facility. So you've contacted an owner, they're interested in selling, now you need to make an offer. And the thing to remember is there is no fixed price for an asset. If 10 different people analyze a deal, they're going to see it in different ways, depending on their experience. You know, someone might see it and think, oh, it's not worth it. Someone else might look at it and say, oh, there's expansion land. With that expansion land, you know, we can do a massive value add. We can make a huge IRR, good return on this project. It's a great deal. So everyone looks at things differently. And with experience, you'll kind of get to a way of analyzing deals for yourself. But the key really is to just try to understand the full picture, to run through all the numbers, run through the income, the expenses, run through what it could be if you ran the facility and you optimize things a little bit, you know, see where there's room for upside. And then if it looks like there's meat on the bone, you know, this looks like a good deal overall, then you can pull the trigger on it. If it looks really, really thin, like there's not much margin for error, you know, if you don't hit your exact assumptions, you're not going to make much money, or even worse, you know, you're going to buy it and just hold it and not really increase the income, then it's probably worth passing on this deal. You want to focus on deals where you see there's a lot of value add to be had, because then you've got a good chance of actually delivering on that. If something goes a little bit wrong, you've still got upside. So we call it a margin of error, you know, room for error, basically, in case your assumptions are a little bit wrong. If it looks fantastic, then there's much more likely that it's going to turn out well for you as well. So what do you want to do? You kind of want to get the basic information first. You know, you could even value a property just off a few simple numbers. For example, if I know it's 50,000 square feet, I know the average rent is $10 per square foot in the area. So then I know I'm going to get around $500,000, 50,000 square feet, $10 per square feet per year, $500,000 income. That's how much the revenue is going to be roughly. If I take away, say, 10% for vacancy and delinquency, that's 50,000 gone. And then expenses, 30%, so 150,000 gone. That will leave 300,000 left over roughly as the net operating income. And so how much is 300,000 worth to you? Basically, if the cap rate for this kind of asset is 5%, or let's say 10% to keep it simple, if it's 10%, 300,000, it's worth 3 million. So I've done a really rough calculation of roughly what the assets should be worth. If the owner is leasing it out at, you know, $6 per square foot and the market's $10 per square foot, there's obvious upside there, right? You can do a quick analysis and know, okay, there's potential here. Or the price is reasonable, but then there's, you know, huge amount of expansion land, so you can add another 30, 50, 40, 60,000 square feet to the property. That's also the value add and upside. You can see, this could be potentially a good deal. It's worth diving into further. When you first look at the deal, when you first get the numbers, if it looks bad, maybe you don't want to spend too much time on it. At the beginning, run the numbers on every single deal in detail that you're looking at just to get familiar with it. But over time, you'll be able to look at a deal and instantly know if there's going to be meat on the bone, if this is going to be a great project or not. Okay, so we get the basic information, the financials, the size, how much rent it's collecting, the overall expenses. We do a quick evaluation. In the meantime, we're also collecting all the detailed information. We want the unit mix. We want all of the profit and loss from the seller. We want the bank statements so we can cross-check everything, as well as everything else that follows as well. So, for example, you know, any contract, lease agreements, insurance. You want to check those things as if you were doing due diligence. And the main thing is just to make sure that all the numbers match up and you know the exact picture of the property. If the owner's profit and loss and the bank statements and the expenses are different, there could be a reason why. It could be because, you know, sloppy accounting. It could be that they're not quite representing it the way it really is. It's on your shoulders to basically verify the exact income and expenses of the property for your own self. So what you want to do then is estimate the income now and in the future, say 1 to 2 years out, once you've stabilized the property. Let's say the occupancy is low now, it's at 60%, but in the market is pretty full in general, then you want to kind of work out, okay, how does it look now at 60%? How would it look if we got it to 90% occupancy or 92% occupancy, which is stabilized? What do the expenses look like now? And how do those reflect 1 or 2 years out once we've done some adjustments? You can then work out what the true NOI should be for the property, and using a cap rate, which is basically, the percentage yield that those kind of assets generally yield, then you can get a rough value of that. And when it comes to due diligence, you're diving in much, much deeper later to actually verify everything that you've assumed now. And you're also looking for any red flags that could potentially, kill your assumptions, kill your model, kill your deal, etc. later on. So estimating with cap rate, this is a really simple way of calculating the value. It's just one method that people use, and that is simply to take the net operating income as it is today. Let's say it's $100,000. You take the price, which is $1 million for this asset, is what it's listed at on LoopNet, and the cap rate is 10%. So it's the net operating income divided by the price gives you the cap rate, 10%. And what this is saying is if I paid $1 million for this asset now, I'm going to get 10% profit yield, which is the $100,000 net operating income. The higher the cap rate, the better for you as a buyer, and the lower the cap rate, the worse for you as a buyer and the better for a seller. If they're selling at a 1% cap rate, so on $1 million, you'd expect to make $10,000 a year. That's great for them, but it's not for you. You're only making 1% yield at best, based on the current assumptions of the income and the expenses. So cap rate, again, is not set in stone, especially with something like self-storage, where you're dealing with mum and pops, you're dealing in markets. There's no absolute fixed cap rate. Even when a broker tells you this is how much it's worth, this is how much you can get from it in the future, these are going to be your returns, don't take any of it at face value. Brokers are there to sell assets, and of course they're going to talk it up a little bit because they know they want you to be interested and they want to negotiate and they want to get a deal done, because selling is what makes them money. So they don't really always also present the true picture of the asset itself. You need to understand that. So you need to know the true rents for that market. You need to have a good understanding of what the true expenses should be for a property as well. And we're going to run through a case study here to show you how to actually value a property with a financial model in a separate video for you as well. So cap rate is just one. Another one we like to use is simply to take the amount of square footage and apply a price per square foot. So at the moment, we like to try to get assets at $90, $100 per square foot if their rents are above $12 per square foot on average per year, right? So we've got a good return built in that way. And this simple maths, so 50,000 square foot, $10 a square foot, 500,000 income, take 30% for expenses, you can expect the balance to be the net operating income as a rough number. And if the price is too far off what that should be, then you've got a large distance. But again, with price, the seller might say they want 5 million. You calculate it's worth 3 million. They might do the deal at 3.1 million. You don't know until you try. So you don't want to completely piss them off. You don't want to do something to destroy the relationship with the seller, but there's nothing wrong with coming in with a lower price and justifying that, saying, based on our calculations, we think it's worth 3.2 million, and that's what we're willing to offer. They may get offended. Some people may even call you all kinds of names as a result of your low offer, but at the end of the day, you've got to buy deals at good prices. So if people get a little bit offended, that's okay. You don't want to end up overpaying for an asset to keep a seller happy and then finding that you can't make your returns, you can't make your money back in the long run. How do you find the right cap rate? So again, like I was saying, with storage, it's too varied, honestly. Like for the REIT style asset where it's 200,000, 150,000 square foot facility right in the center of town, they're going to have very suppressed cap rates, which means if you buy it for $10 million, you can expect 3, 4, 5% yield on your $10 million investment, which is very, very low. When it comes to secondary markets, tertiary markets, suburban towns, mom and pop operators, you've got a lot more leeway with that, and so there's no fixed cap rate. You may find that you're purchasing assets anywhere between 6 to 10% initial yield when you buy the asset. Of course, the higher the better, but really what we're looking at is not the picture today. Of course, we want that to be as healthy as possible, but the realistic picture in a year or two of where the asset's going to be once you implement some changes. If you can buy the asset at 10% cap rate day one, of course that's even better, and then you can jack up the rents, reduce the expenses, and get that cap rate and cash on cash way up. That's of course the best scenario, but sometimes you have to give a little bit of leeway now with an asset in terms of the price you pay, because you know there's so much more value in there that the seller hasn't fully captured. For example, if the seller's asking for a 5% cap rate on an asset, they're asking for $2 million for an asset that generates only $100,000 profit a year, you might look at that and say, no, it's too low cap rate. But what if I was to tell you that their market rents are 50% below market? That cap rate becomes irrelevant, right? We've got to look past the initial numbers. We've got to look past the cap rate, because if I can jack up rents 50%, my profit's also going to go up 50%. My cap rate is instantly restored to a much higher number, a much better cash on cash yield. So the numbers are there not to tell you the exact answer, but to give you the picture of what's happening. You've got to look through the numbers to understand the real asset and see, is there meat on the bone here? Is there some value add I can do, instead of trying to buy it at a great price, like 7-8% cap day one, and then there being no upside whatsoever. Of course, you want to negotiate up front, but don't overfight the pennies if there's lots of dollars to be made later because the sellers mismanaged the asset, for example. And the best example of this is, let's say you're in a market where nearly every competitor's full. For some reason, this storage facility isn't full and the rents are below market, right? So there's an opportunity there. Of course, you want to protect your downside. You don't want to overpay for that asset in case there is another reason why that particular asset isn't hitting those numbers on the occupancy and the rents, but usually it's just mismanagement. There may be a visibility issue, but that's something, again, you need to check by going to the site, due diligence, etc. So all of this valuation stuff, although we're using precise numbers to do valuations, none of it's precise. It's all about understanding the wider picture of the market, the competition, how that asset stands in the competition, how much you're willing to pay now, and how much potential upside you have built in as well. There's other factors you need to consider. What if there's deferred maintenance? Is the market, strong? The demographics, the people, is it growing? Is it shrinking? What's happened to the rents over the last 12, 24 months? These are some things you can't just see from the snapshot expenses and bank statements today. What are the market rents compared to at the other properties around? How do you plan to operate the property? And then also, what have other assets traded for in the area? And with a lot of markets that you're going to be dealing in, a lot of them will have no comparable sales. And even if someone does throw comparable sales at you, you still want to push for the best deal possible for yourself. So you want to keep that initial price as low as you can per square foot that you're buying the asset for. Okay, so you've done a quick evaluation. It looks like there might be, expansion land. It looks like the rents are below market. Then you're getting the full financials. You're recreating the financials for yourself in a financial model. You're going deeper on the market. You really want to understand all of the competition, their rents, their occupancy, their unit mixes. You want to see if there's anything quick you can do. You want low-hanging fruit. If there's no security gate, there's no security cameras, there's no lighting on your facility, there's no sign, occupancy is 60%, but it's in a great location. Some of the units look a little rough, you need a paint job. These are all quick fixes that don't cost a lot of money, that can really improve your asset and help you to then lease it for higher rents. And if you find that it is a good deal, you need to make an offer and move on it quickly, because you don't want to lose the deal to someone else. The seller may get the idea of listing it with a broker if you found it off market, for example. So why is financial modeling important? Basically, a financial model is like a prediction of the future. When you just pull together, the numbers and you look at them statically, the expenses, the income, the profit and loss, the unit mix, you kind of get an idea of the asset, how it is now. The financial model helps you basically project out the future. How could the future look for this asset? And what are our assumptions for that? It's basically like a magic 8-ball. It's basically, you're plugging in everything in, you're checking your assumptions, and then seeing what the future is going to look like. Is there profit here to be had? So, to put together your model, you're going to need as much information as possible. So, what's going to be the purchase price for the asset? What are the closing costs? Are you going to have any reserves, which, are highly recommended? You have at least 2 full months of expenses and reserves, if not more as well. What capital expenditures are you going to have to spend? If you're planning on making improvements, you need to factor that into your model, because that's going to affect your returns too. You want to know the gross square footage, the net square footage of the storage available. How much of that is climate controlled? How much is non-climate controlled? What does that unit mix actually look like in terms of, 5x5s, 10x10s, 10x20s, 10x30s? Is it heavily weighted to larger units? Are those popular in that market? Is it heavily weighted towards smaller units? Is that market popular for that? Tends to be that smaller units have higher rents per square foot than larger units. Okay, then you want to know the rental rates. One, what they've been charging, the historical rental rates at the particular facility that you're evaluating, but you also want to know the competition and the general trend. And a tool like Radius Plus can show you that information, plus cold calling the competitors then gives you the additional info of where their rents are at now, and you may even be able to assess the occupancy, how full they are from a phone call. If you call a competitor and they say, no, sorry, I have no 10x10 units left, okay, how much are they normally? Oh, they're about $120. So you now know they're all full. You've got a price roughly of how they are. And if you do that across the board and you find most competitors are full, then you can see this is a very strong market. And the next thing that's probably going to happen there is that rents are going to increase as a result. You want to assess the vacancy, any concessions, any credit loss percentage. If you have some occupancy below, let's say the occupancy is below 92%, let's say it's sitting at 70%, you're going to need time to fill up those empty units, and you're going to need marketing budget to fill up those empty units. So you need to allow for that lease up to happen as well into your model too. And usually, depending on the market, we allow anywhere from 1,500 to 4,000 square feet of storage to be leased up per month. But if you're out of season, for example, let's say it's winter, nobody's moving in and out, then it's very hard to hit those numbers and you need to allow more time. So that's why the financial model is your way of working through your business plan and what's going to happen with your property over the next 12 months, 24 months and 60 months. So you fully understand, how things are going to play out and what's your plan, and also what you need to spend on marketing, on capital expenditure, in addition to your equity, in addition to your closing costs, to actually make this asset into a cash cow for yourself. You also want to collect the real estate taxes, the insurance, the payroll, what's been spent on repairs and maintenance, on their accounting and legal, on any software. Snow removal can be expensive in some places. Landscaping, what are the utilities, and the credit card fees. So you want to gather all of the expenses too, as they are now, but also you want to sense check those expenses against some other properties, because sometimes some sellers have too high expenses, some are underreporting expenses. So don't always use the expenses the seller gives you as gospel, as this is the exact expenses. They may be totally wrong, and you need to kind of sense check those and verify those for yourself too. You also want to know, basically what your financial model is going to look like in terms of a loan, right? So what's the structure of your loan? What's the cost? Are you going to be paying interest only for a couple of years? What's going to be the principal and interest payments later? You want to input all of that into your model as well, so that you can fully understand the whole picture of the deal, including your financing, including your equity and down payment that you put in as well. So then there's different ways of looking at it in terms of, is it a good deal? So one way is to look at the internal rate of return. And basically what this is over a 5-year period, if I put $100 in now, what percentage am I going to get each year compounded over the course of the 5 years? And we'd like to target a 25% IRR for a project, which means if I put $100 in now, it's going to be 125's worth next year, times 1.25 the following year, etc., etc. So it's growing by 25% per year onwards. With multifamily deals and some other asset classes, these numbers are much lower. They may be targeting 12 or 15% IRR over the life cycle of a deal. With self-storage, we tend to look for higher IRRs because we want deals that knock it out the park. We don't want deals that just coast, that we just own and hold and make a little bit of money on. We want deals where there's real serious value add, because that's how we generate wealth for our investors and for the Patriot team as well. The other way to look at the valuation again is the equity multiple. So if your closing costs, your equity down payment, capital expenditures is $1 million, and after all your improvements you expect the facility to increase in value by 2 million, then you've basically made 2 million on top of your 1 million, so you're basically getting 3 million back. So 3x equity multiple, that's what that is. It's how many times your original cash that you put in are you getting back. And some deals, you look at them, you put in $1 million, after all your hard work, effort and spend, you might get 1.2 million back total. Is it worth it for that 20% bump over the course of 5 years? And that's if everything goes right. So if it's a low equity multiple, a low IRR, we tend to avoid the deal because we don't want to do deals which are too low potential return. And you'll know, it's the same. You don't need to know someone's exact weight to know whether they're fat or not. I can't remember who said this quote. I think it might have been Warren Buffett, but that's how he evaluates companies. He looks at companies and he looks at investments and he says, okay, there's fat here. There's profit to be had here. You don't need to know exactly how much someone weighs. You don't need to know, the exact numbers of a deal to see that there's plenty of meat on the bone. You can see, they're way below market rents, or there's expansion room, and all these different value add things that you can do, or their expenses are way too bloated. If you cut those down, the NOI can go up. If you increase occupancy, you can increase the NOI as well. So you're just looking for those home run deals, not the deals where you're really not sure if there's any profit to be had. And then the other thing to look at is, of course, the cash on cash return, right? So let's say you're putting in $1 million in equity and closing costs and improvements. How much actual cash flow after all your expenses, after all your loan payments, interest and principal payments, how much cash flow is that going to generate? And you want that to be a healthy number so that it can support the asset and actually generate a profit as well.
For more information on commercial real estate investing, go to patriotholdings.com. Thanks for listening.